Assalamualaikum and good evening. Today our group will present an overview for the Z company for interpretation of financial statement for 5 years comparison for subject property finance and accounting. To begin with, for the background company, firstly, Z company was founded in the mid-1990, officially broadcasting in 1996. Z company is the pioneer of paid TV service, which is Malaysia. Today, Z Company is one of the largest media content provider in Malaysia, offering television, streaming, radio, and broadband services. Z Company also approximately 5.3 million households, representing about 65% of Malaysia TV household, and operate platforms such as TV Enjoy, Suka, and so on. The detailed analysis, which is liquidity, efficiency, profitability, and gearing. Firstly, liquidity for the current ratio. The current ratio, which is determined by dividing current assets and current liability, is a liquidity ratio used in financial analysis to assess a company's capacity to satisfy its short-term commitment with its short-term assets. We can look at the graph. In year 2020, the current ratio is 0.62. The financial health status is moderate stress because it's impacted by initial COVID-19 lockdowns. For 2021, is critical low. The current ratio is 0.20. Severe liquidity pressure due to collapsing. In 2022, the current ratio is 0.75. This is a transition phase recovery to better working capital management. 2023, 0.80 is a consistent improvement, stabilizing cash flow. In 2024, 1.15. This is a strong ability assets and asset liability for the first time in this period. Next is a quick ratio. We can look at 2020 to 2021 recovery from 0.64 to 0.92 due to improved cash management and tighter liability control. For 2022 and 2023, a temporary dip to 0.74, higher operating or content costs, followed by stabilization at 0.79. Lastly, at 2024 breakthrough, a sharp rise to 1.15, surpassing the ideal 1.0 benchmark and signaling a high-quality liquidation position.
Thank you, Danish. I will now discuss Company Z profitability performance, which measures the company's ability to generate profit from its sales, assets, and shareholders' equity. The key ratios analyzed are gross profit margin, net profit margin, return on assets, and return on equity from 2020 to 2024. First, the gross profit margin shows how efficiently the company controls its cost of sales in 2020. Company Z recorded a strong gross profit margin of 38.6%, indicating good cost control and pricing power. However, the margin declined steadily over the years, falling to 29.8% in 2024. This consistent downward trend suggests increasing cost pressures, such as higher content costs, operating expenses, and intense competition from streaming platforms. Overall, Company Z has found it increasingly difficult to maintain its gross profitability. Next is return on equity, measures the return generated for shareholders. Company Z ROE was exceptionally high at 52.3% in 2020, but it declined steadily to 29% in 2024. Although the company still provides positive returns, the continuous decline suggests reduced efficiency in using shareholders' funds. From an investor perspective, this downward trend may reduce confidence in Company Z's ability to sustain strong shareholder value in the future. Next is the net profit margin, which reflects how much profit remains after all expenses including interest and taxes. Company Z net profit margin decreased significantly from 13.1% in 2020 to just 0.8% in 2024. While the company was clearly profitable in the earlier years, profitability weakened sharply after 2022. By 2024, Astro was operating close to break-even, meaning even small increases in cost or drops in revenue could lead to losses. This trend highlights serious concerns about long-term profitability. Last is return on assets, measure how efficiently Company Z used its assets to generate profit. In 2020, return on asset at healthy 9.1%, but it dropped sharply to 0.5% in 2024. This indicates that Company Z assets are generating very low returns in recent years. The sharp decline after 2022 suggests underutilization of assets, weaker earnings, or investment that have not yet produced sufficient returns. Next, I will pass to Danish to continue about average inventory.
Next part, the detailed interpretation for efficiency. Average inventory. In general, average inventory gives analysis insight into how well a business operates and how well it can turn inventory into sale. For this Z Company average inventory from 2020 to 2024, Z Company average inventory first declined from 14.55 million to 12.95 million during the pandemic for cash preservation, then rose to 20.85 million by 2023 as operation expanded, before slightly decreasing to 90 million in 2024, reflecting a shift from cautious stockholding to aggressive accumulation, and finally to more efficient optimized inventory management aligned with operational needs and financial stability.
Next, for the inventory turnover, high turnover reflects a service-based model where equipment such as decoder is deployed rapidly rather than stored. For 2020 and 2021 is the peak efficiency, set from 207 to 232 times, driven by aggressive cost saving and lean inventory management during the pandemic. For 2022 and 2023, strategic decline, the ratio dropped significantly to 168 in 2022 and 190.70 in 2023 as the company reboots stock for service upgrade and technical advancement, leading to the higher capital tied up. Lastly, for 2024 is a stabilization year. A slight recovery to 123 times indicates a better alignment between inventory purchases and actual operational demand. Next is average receivable. Z Company demonstrates aggressive improvement in cash flow by significantly reducing the capital tied up in unpaid invoice over the 5-year period. We can look at 2020 and until 2023 is a rapid improvement. Average receivable dropped from 938.5 million to 644 million. This indicates faster collection cycle, tighter credit policy, and reduced risk of bad debt. And 2024 is stabilization, a minor uptick to 651.5 million, suggests collection efficiency has offering flexible credit terms to drive new sales growth. And lastly is a debtor turnover, show a period of significant growth in collection efficiency, rising from 464 times in 2021 to a 5-year peak of 5.75 times in 2023. This upward trend highlights a high-quality debtor base and a period of peak management effectiveness in converting credit sale into cash. However, the ratio declined to 5.13 times in 2024, suggesting a slowdown in collection velocity. While the performance remains stronger in 2021, the recent drop indicates that it now takes longer to collect customer payment, potentially due to a strategic shift toward more flexible credit term or external pressure on consumer payment speed.
I will now move on to gearing. As you can see, the debt to equity ratio indicates the proportion of debt used relative to shareholders' equity. Company Z debt to equity ratio remained relatively moderate throughout the period, ranging from about 16% to 27%. This suggests Company Z does not heavily depend on debt financing and maintains a balanced capital structure. Although there was a slight increase in gearing in certain years, overall financial leverage remains manageable and not excessively risky. Next is the interest coverage ratio, measures Company Z ability to meet its interest obligations from operating profits. In 2020, Company Z recorded a very strong interest coverage of 20 times, indicating a high capacity to service its debts. However, this ratio declined significantly to around 6 times in 2023 to 2024. This decline reflects reduced profitability rather than excessive borrowing, while Company Z is still able to make its interest payments. The lower coverage ratio signals increased financial pressure and reduced safety margins.
In conclusion, it needs to focus on improving operational efficiency,
strengthening digital revenue streams, and controlling costs to share to restore profitability and ensure long-term financial sustainability. That's all from us. Thank you.